Hello, everyone. I'm Jan Vega, a wealth manager in our Los Angeles office, and I'm joined by my colleague Laura Boucher from our Milwaukee office. We welcome you to today's call to hear John Allen, our Chief Investment Officer, and Marc Castellani, a Managing Director of our Investment Strategy and Research team, discuss key developments of recent legislation, global policy and Fed policy, and what these changes may mean for your portfolio and long-term investment strategy. Since our last webinar, the Big Beautiful Bill was signed into law, bringing broad changes to government spending, tax policy, and the regulatory landscape. Meanwhile, we also have the trade policies and tariffs, which remain in flux, all presenting both emerging opportunities, but also new sources of risk. At the same time, the Fed is carefully finding the right balance between managing inflation and watching signs for slowing growth. So we recognize that this is a period of heightened uncertainty. Sudden changes in policy and market dynamics all can be very unsettling, and we want you to know that the Aspiriant team is here to support you with perspective, guidance, and clarity. So to make the most of our time today, we want to encourage you to share what's top of your mind. You can submit your questions using the dialog box on your screen at any point during the discussion. The presentation slides are also available on your screen, and a recording of today's session will be shared with you shortly after today's call. So with that, let me turn it over to John to get us started.
Thanks, Jan. Hello, everyone. From many perspectives, the economic picture appears mixed to us. We don't believe that that's fully reflected in financial markets. The rapid recovery since the pullback earlier this year has probably brought some calm to many of us, but it also has raised a lot of questions. In this kind of environment, it's critical to monitor any developments when it comes to fiscal and monetary policy. So let's dive right in. As we touched on last quarter, the U.S. is the wealthiest country, resulting in consumption that outpaces our domestic manufacturing. While there are different ways to respond to a country's worsening trade balance, the Trump administration broadly increased and applied import tariffs on dozens of our trading partners. These tariffs and other shifts in fiscal policy have caused concern for the U.S. dollar, as well as financial markets, economic growth, and inflation. Meanwhile, monetary policy has remained consistent, but as Marc and I will explore, there may be room for the Fed to reduce short-term interest rates and therefore ease going forward. Over the past several decades, globalization, also known as specialization, has contributed to the steadily decreasing inflation and has improved our standard of living. But at the same time, it has threatened our domestic manufacturing capacity. In addition, our reliance on other countries to develop or manufacture critical components, such as semiconductors, has left the U.S. vulnerable to supply chain disruptions and foreign influence over strategic technologies. And at the same time, significant U.S. trade deficits necessarily led to significant U.S. capital inflows. In 2024, the trade deficit reached a record $918.4 billion, with exports at $3.2 trillion and imports at $4.1 trillion. But those trade deficits also resulted in significant capital inflows into the country in the form of U.S. public equities as well as other investments. And U.S. public equities today represent about $60 trillion, or 2/3 of the global equity market capitalization. And the value of U.S. Treasuries now has reached $27 trillion, with foreign ownership representing $9 trillion, or roughly 1/3. Importantly, while policy shifts can feel unsettling, the U.S. remains the strongest country overall. Later today, I'll describe how the U.S. was number one in 2022 based on an index of 8 key measures of power. And while the U.S. may be facing some tougher decisions today than it was just a few years ago, improving any or potentially all of those 8 metrics can help a country navigate through the toughest of times. In addition, the country is rapidly strengthening its capabilities in terms of critical areas such as automation, advanced machinery, robotics, artificial intelligence, and AI-enabled national defense. However, to us, the key challenge is U.S. equities, especially growth stocks, which are highly valued with little room for error. And it doesn't appear that investor speculation has been completely quelled, with headlines this week of a new list of meme stocks, including coal and Open Door Technologies, both of which are actually struggling businesses, but they have one thing in common that day traders love, and that's significant short interest by hedge funds. Okay, the top chart on slide 5 shows the US has had a deficit with its trading partners since the early 1990s. Over the past 3.5 decades, the trade deficit has worsened, especially in recent years. While we have had a voracious appetite for spending, we've also collectively had the wallet to pay for what we've consumed. In fact, the US is the largest economy by far, with gross domestic product at roughly $30 trillion, representing 27% of the world's total GDP. By comparison, Europe, including the UK, produces about $20 trillion of output, and China produces about $19 trillion of output. The bottom chart shows the impact of Trump's announced but evolving tariff package. The orange line plots the average effective tariff rate across US trading partners. The dark blue dot indicates the expected average rate based on the tariffs that were announced on April 2nd, which was dubbed Liberation Day. The light blue dot is our updated estimate based on new announcements and negotiations that have occurred over the past few months. Clearly, the shift represents the most significant change in US trade policy in nearly a century. As currently negotiated, the package would raise the effective tariff rate from about 2.5% to approximately 20%. And while the increases would be significant given today's standards, tariffs at or above these levels were once common. It's important to note that trade restructuring is still underway, with more than 50 countries, now including China, actively negotiating their terms of trade. It's also important to note that tariffs aren't necessarily a tax on just the consumers or the producers. They could be absorbed in part or in whole by one or both parties. But in either case, higher tariffs likely mean fewer transactions or consumption in exchange for revenue that would have otherwise taken place. So real economic growth almost certainly slows. From an investment perspective, a low growth, low inflationary environment is disinflationary and generally good for nominal bonds and other defensive assets. A low growth but high inflationary environment is referred to as stagflation and generally good for businesses that provide necessities and can pass along inflationary pressures to consumers, including consumer staple businesses, healthcare, and utilities. Inflation-adjusted bonds, such as Treasury inflation-protected securities or TIPS, and precious metals such as gold also tend to do well, which partially explains why it has rallied throughout the market turbulence. All right, with that, let me turn it over to Marc to walk through some early readings on how the tariffs, among many other factors, are affecting the US dollar, international equities, gold, and economic growth.
Thanks, John. One of the bigger stories of the year has been the decline in the dollar. Measured against a basket of 6 major international currencies, the dollar declined by almost 11% during the first half of the year. That 6-month decline was the steepest in over 50 years. Nevertheless, the dollar since 2008 has been on a long run of outperformance, as marked by the blue parts of the line in the top chart of slide 6. Periods of dollar depreciation, conversely, are represented by the orange sections of the chart. As illustrated in the chart, durable currency cycles in either direction tend to occur over 5 to 10 years, with the current period of dollar outperformance by length and scale a bit of an outlier from the patterns of the past several decades. Over long intervals, currencies tend to mean revert and oscillate around historical averages. Notwithstanding a decline in the first half of the year, the dollar still looks relatively expensive and may have more room to fall if this is the start of a sustained period of dollar weakness. Given the size of the US economy, it's not surprising the dollar has had an outsized role in the global economy. Dollar assets represent the preponderance of global central bank reserves. Sure, the dollar's share of global reserves has declined from 85% to about 60% over the last 55 years, as shown in the bottom chart of slide 6. But the alternatives to the dollar are quite limited. The rule of law, deep liquidity, unrestricted capital mobility, broad use and trade settlement, among other characteristics, continue to make the dollar and dollar assets the preferred option for central banks around the world. From an economic standpoint, a weaker currency can stimulate exports and domestic tourism, as U.S. goods and services are cheaper to foreigners. A cheaper dollar, or alternatively, stronger international currencies also boost financial returns for U.S.-based investors as the local returns of foreign markets convert into more dollars. As you can see on the top chart of slide 7, only recently has holding European equities, for example, been a relative winner to investing in the S&P 500, with this chart sharing a close resemblance to the currencies chart from the prior slide. While it may seem a falling dollar is advantageous, it does present some risks. International goods and commodities become more expensive, potentially leading to higher inflation and a loss of purchasing power. Foreign investors bear the opposite effect on their financial asset holdings, with a weaker dollar leading to shallower gains or larger losses from holding U.S. stocks and bonds. Now, this can prompt capital flight out of the U.S. and lead to higher interest rates, further currency weakness, and a loss in confidence in the dollar as a reserve currency. Now, many parties think of gold as a different form of currency. For thousands of years, gold has played a central role in monetary systems and did so up until the start of 1971, when the U.S. abandoned the dollar pegged to gold. Since then, the price of gold has tended to exhibit an inverse relationship to the level of real or inflation-adjusted yields on similar safe haven assets. Since gold generates no income, a higher real yield on assets like U.S. Treasuries would tend to limit the attractiveness of gold as a holding given the opportunity cost of doing so. Lower real yields would invite the opposite response and generally coincide with periods of rising gold prices. The relationship between real yields and the price of gold held up reasonably well until recently, when gold continued to rise at a time when real yields also marched higher. Over the past 3 years, the price of gold has generated a 22% annualized return, and just this year is up 26%. Even with these recent gains and a break in the relationship with real yields, the price of gold relative to the price of the S&P 500, as depicted in the bottom chart on slide 7, is near historical average and seems reasonable. With limited supply, gold, unlike paper or fiat currencies, has been viewed as an alternate store of value to dollar-denominated assets, especially among the central banks of China, India, Turkey, and other emerging market countries. Over the past 3 years, gold purchases among central banks have been the highest in 50 years. The buying among these central banks and others is intended to hedge against a range of bad outcomes, including geopolitical risks, inflation, fiscal uncertainty in the U.S., and further weakness in the dollar. In other words, gold offers diversification and a tail risk hedge and can be a valuable holding in periods like today of rising uncertainty. Transitioning to the economy, economic growth is stable with some pockets of potential concern. First quarter real U.S. GDP growth was negative 0.5% due to a surge in imports ahead of the anticipated implementation of more severe tariffs. For the full year, expectations are for real GDP growth to stabilize at around 1.5% to 2%, marginally better than other developed markets, with China expected to grow at a rate slightly above 4%, as shown in the text on the right of the top chart of slide 8. While estimates suggest importers absorb 20 to 40% of the cost of tariffs, the effect of changing trade policy to date on the broader U.S. economy and consumer has not been that pronounced. Goods, the part of the economy most sensitive to tariffs, represent only about a third of consumer spending. And core control retail sales, a measure that excludes spending on autos, gasoline stations, and food service, grew around 4% year over year in June. Now, though the consumer and U.S. economy is showing signs of resiliency, areas of stress do linger. The aggregate data can mask some of these challenges. For example, the bottom chart on slide 8 shows delinquencies across a range of loan types. Mortgage delinquencies are in the dark blue line, and overall consumer debt delinquencies, the black line. Those data sets look normal relative to history. However, delinquencies in credit card debt in the peach, auto loans in the dark orange, and student loans in the traditional orange are all trending higher and represent categories of borrowing most heavily used by lower income households. Affordability has been an issue for this segment of the population for the last 3 years, and that continues to be the case. So with that, let me turn it back to John to pick up the conversation on inflation as well as other economic conditions.
Thanks, Mark. Okay, so the top chart here on slide 9 indicates that current and expected inflation appears in check. The core consumer price index, or CPI, which excludes the more volatile energy and food categories, currently stands at about 2.9%. Services inflation is at 3.4% year over year, while goods inflation is at 1.5% year over year, both of which are similar to their levels pre-COVID. There are a variety of ways to look at expected inflation. One such way is what the market expects annualized inflation to be 5 years into the future, which we haven't shown here. But that data suggests that from 1998 to 2025, typically future expected inflation was between 1 to 4%. Post-COVID, it was roughly 5%. Looking forward 5 years from now, the market expects inflation to come in at about 3% per year. If so, that would obviously be higher than the Fed's target of 2%. The bottom chart provides a snapshot of the second prong of the Fed's dual mandate, which is employment. Currently, the employment picture appears strong, but it's beginning to soften at least a bit. Across the country, we have about 7 million unemployed people out of a total workforce of 170 million, which equates to an unemployment rate of roughly 4.1%. As you can see, that's among the strongest jobs readings we've had dating back to the early 1990s. And looking into some of the underlying characteristics, average annual wage gains are currently running at about 3.5%, and over the past 5 years have recently caught back up to their necessities inflation, which you'll recall skyrocketed after or going through and after COVID. There's currently 1 job opening for every 1 job seeker across the country, which is similar to the pre-COVID period. And productivity, while holding steady at about 1% per year, hasn't yet shown any discernible impact from artificial intelligence, although we expect to see that change going forward. Indicating some softening, the duration of time for which a person is unemployed has been ticking upward and currently stands at 25 weeks. The top chart on slide 10 tracks the leading economic indicators index, which is a composite of 10 indicators that have historically presaged economic expansions and contractions. Some of the indicators included in the index are average weekly hours, average weekly unemployment claims, new orders of manufactured goods, and new housing building permits. A positive change indicates expansion, while a negative change suggests a weakening. An LEI below 0 indicates a recession could lie ahead. As you can see, whenever the index fell below -5% since 1990, a recession did indeed occur. The measure currently stands at minus 4%, but seems to be searching for a definitive direction. If LEI weakens from here, we could enter a recession, and we put those odds at about 1 in 3. However, if LEI strengthens, we'd expect to have low but stable economic growth going forward, with GDP coming in at about 1.5% to 2% annualized, as Marc described earlier. The bottom chart indicates that the market isn't expecting interest rates to be as low as they were during Trump's first term. The orange line represents the current interest rates or yields on US Treasuries across different maturities from 1 month to 30 years. By comparison, the light gray line represents the level of interest rates just prior to Trump's first term. Across every maturity, from short to long term, interest rates were significantly lower then than they are now. So going forward, we may not have the tailwind any longer behind growth in equities as we have had in recent years. It's important to remember that short-term interest rates are influenced by the Fed's monetary policy decisions, with the Federal Open Market Committee, FOMC, setting the short-term Fed funds rate. That rate stands at 4.3% and is currently expected to decrease to about 3.5% in 2026, with either 1 or 2 rate cuts of 25 basis points each over the next 6 months and another 2 in 2026. However, expectations could change. Jay Powell's term as Fed chair ends in May of 26, while his term as a member of the Federal Reserve Board of Governors extends to January 2028. And for what it's worth, we don't think Trump will fire Jay Powell. We could be wrong, but we also don't think that he's got the power to do so. But nevertheless, Trump will appoint a replacement in just 10 months, who will likely be chosen, at least in part, based on giving assurances to Trump that he or she supports a lower interest rate environment. While the Fed's policies set short-term interest rates, long-term interest rates are set by the market, and those may not decrease if and as short-term rates decrease. For example, if lower short-term interest rates spur spending, which leads to higher than expected inflation, then lenders, the bond investors, may require higher interest rates to offset the inflationary pressures. And the long end of the yield curve principally affects long-term borrowing, for example, mortgages and business loans. If higher interest rates persist on the long end of the curve, we'd expect to see real estate and capital investment face headwinds. Additionally, the long end of the curve is being buoyed by the slow but steady unwinding of central bank balance sheets of the G4 regions. And those regions are the United States, European Union, the UK, and Japan, which have been reducing their government bond holdings. Okay, given the political divides across the country amplified by the administration's shifts in fiscal policy, among probably arguably other factors, we've had a few clients inquire about whether or not the US is in trouble compared to other countries. Ray Dalio, the founder of Bridgewater, which is the largest hedge fund in the world, has been one of the leaders researching that very topic. He refers to it as the changing world order, which is predicated on the changing trajectories of each country's power. He studied the world's 24 leading countries over hundreds of years, and in 2022 published his results, including a country power index, which he created as a composite metric of the 8 key measures of power shown on slide 11. Those are markets and financial center, innovation and technology, military strength, education, reserve currency status, economic output, trade, and cost competitiveness. Now, Ray has said that those aren't necessarily the only metrics one could monitor, but whatever metrics are used, it's important to be able to systematically assess them over many decades, since world leadership tends to persist for many years. As you can see, the US was the number one country on the first 6 of these 8 metrics. It was number 3 on trade, and it was number 14 in cost competitiveness. So overall, the US came in as the number 1 country in 2022, but according to his analysis, was also experiencing a gradual decline. He had China coming in at number 2, but in gradual ascent, and therefore was closing the gap on the United States. The other 22 countries are quite far behind, including even if you added all of the European countries together and counted them as one unified Eurozone. Just a few months ago, Ray published a book entitled Why Countries Go Broke. In it, he offers words of caution, if not concern, that all of the world's superpowers, including the United States, Europe, the United Kingdom, Japan, and China, could lose their standing in the global order in the coming years if they don't begin working on their problems now, many of them which stem from slow growth and increasing debt. To avoid or lessen the related problems, he offers some advice that's good for any government, business, or household. Earn more, spend less, and reduce your borrowing costs. Applied to governments, earning more means increasing federal inflows. That could be achieved through higher taxes on individuals, corporations, and others, as well as faster growth in population and productivity, and therefore the economy. Some of these would weigh on future equity returns, while others would boost them. Spending less essentially means reducing or eliminating internal and external financial support for government programs. Depending on which programs were impacted, these steps would likely weigh most heavily on some businesses as well as the most vulnerable households. Reducing borrowing costs, both by decreasing the policy rate as well as accepting higher inflation, would weigh on debt holders, both domestic and foreign. Okay, in addition to the metrics in Ray's work, it's also noteworthy that the US enjoys a number of advantages. While imperfect and certainly not continuously felt by every American, the United States is a democracy governed by democratic processes and controls. We are an egalitarian people when it comes to basic human rights and support merit-based opportunities with social safety nets for those in transition, as well as the most vulnerable among us. We have deep and liquid financial markets, including venture capital investing, which allows us to fail forward when it comes to innovation and technology. We generally support the rule of law and the protection of property rights. Our country has an abundance of land with a temperate climate and the availability of many natural resources. The country itself is bordered by 2 vast oceans to the east and to the west, with 2 long-standing allies to the north and to the south. So again, while imperfect, the country seems to have several advantages that could help us navigate tough times in the future, just as they have in the past. And as I mentioned earlier, our broadest concern at the moment is the valuation that's been priced into US equities and the potential for capital outflows outside of the United States over the next several years. Okay, so with that, I'll turn it back over to Marc to talk about other fiscal policy developments and then provide some final thoughts.
Thanks again, John. Our colleagues published a detailed summary of the One Big Beautiful Bill Act on our blog, Fathom, and here I'll refer you to that resource and your client service team for a fuller description of the tax legislation and its impacts. Here, I'm just going to provide some of the key takeaways. So one of the main objectives of this legislation was to permanently extend many of the provisions of the 2017 Tax Cuts and Jobs Act. The 7 individual tax brackets introduced in 2017 that were scheduled to sunset at the end of 2025 remain in place, with other elements such as the standard deduction, child tax credit, estate tax exemption raised and also indexed to inflation. Some other items were passed to provide temporary benefits, such as raising the cap on the deduction for state and local taxes to $40,000, providing an additional $6,000 deduction for seniors age 65 and older, new deductions on tips and overtime, as well as interest on auto loans for new vehicles assembled in the U.S. I'll note that all of these temporary tax savings come with phase-outs for higher income households. For corporates, the big beautiful bill includes the immediate and full depreciation of qualified property like equipment and domestic manufacturing facilities, full expensing of domestic R&D expenses, a more favorable business introduction tied to EBITDA, a higher semiconductor investment tax credit, an additional $150 billion in defense-related spending, and another $170 billion in border enhancements and immigration enforcement. Now, some of the more material offsets to fund these provisions are Medicaid reductions from stricter eligibility and work requirements, cuts to the Supplemental Nutrition Assistance Program, or more commonly known as food stamps, repeals or rollbacks to clean energy tax credits, and of course, tariffs or tariff revenue. The Congressional Budget Office estimates the bill will cause the annual federal budget deficit to increase by 1% or more and rise to 6 to 7% of GDP by 2034. As a consequence of this legislation, we as a country more firmly lock in structurally higher deficits, with interest costs alone projected to reach $1.7 trillion per year by 2034. Now, since a large share of the bill's costs comes from extending tax rates that were already in place, the near-term stimulus is estimated to be somewhat modest, around half of a point to perhaps as high as 1% of additional economic growth in 2026 and 2027. Longer term, as the offsets kick in after the 2026 midterm elections, the bill's effects on growth are expected to be neutral to slightly contractionary. So I'll close with slide 13. Despite the volatility of financial markets in the second quarter, the economic picture of the U.S. remains very similar to its trajectory before Liberation Day in early April. Slowing but still positive economic growth, a historically strong labor market with pockets of softness, and inflation moderating but still above the Fed target. Real GDP dropped by 0.5% in the first quarter, driven in part by a rise in imports. The Atlanta Fed forecasting model points to real annualized GDP growth of 2.4% in the second quarter, with the latest Bloomberg consensus forecast of 2.1%. The Institute of Supply Management PMI data shows some improvement in manufacturing, but a contractionary reading of 49. Services data, however, is improving, and with an expansionary measure just below 51. The U.S. unemployment rate of 4.1 remains low and has been relatively stable over the past year. Non-farm payrolls were up 147,000 in June, slightly above consensus forecasts, and in line with the monthly average over the past 12 months. Annual wage growth is healthy, around 4%. However, job gains have been concentrated in state government and healthcare, together more than 75% of the total. And in recent months, revisions to payrolls have largely been negative. Job openings to the number of unemployed is slightly above 1 times, down significantly from the peak of near 2 times in 2022, and now below pre-pandemic levels. And for lower income households, as we've consistently highlighted, affordability remains a challenge, with defaults on credit cards, auto loans, and student loans all rising. Core CPI increased 2.9% year over year as measured last month. In June 2024, so a year earlier, core CPI increased 2.97% year over year, an improvement but just barely, and yet still above the Fed target of 2%, and that's before the full transmission of tariffs or the restructuring of global supply chains. Because of the relatively stalled progress on inflation and the looming impact from new trade policy, we expect the Fed to remain cautious on policy rates. Along those lines, the market is pricing in 1 to 2 25 basis point cuts before year end. Despite the mixed picture and dizziness from changing tariff pronouncements, markets move higher across the board during the quarter. On a currency neutral basis, the U.S. outperformed, a result similar to much of the last 15 years. However, after adjusting for currency effects, U.S. markets lagged international equity indices as they did in the first quarter. The year-to-date results, especially for the dollar, may be an isolated event or the start of a secular movement out of U.S. assets by international investors to gain better balance in their portfolios and/or de-risk their wealth from greater U.S. policy and fiscal uncertainty. From a portfolio construction standpoint, we continue to believe a diversified portfolio that's a mix of U.S. and international stocks and bonds, and if appropriate, also some allocation to private market assets and diversifying assets such as gold, is sensible in this environment. At the same time, investors should remain opportunistic to thoughtfully add risk should market drawdowns occur and provide more attractive entry points, especially over the balance of the year and into 2026. With that, let me turn it back to Jan and Laura for any questions.
Thanks, Mark. We received several great questions during the presentation. We touched on some of them already, but perhaps we can share some additional insights. As a reminder, if you'd like to submit a question, please use the Q&A box on your screen. Let's start with a question related to federal deficit as a result of the One Big Beautiful Bill Act. Should we be concerned about the long-term impact of more government debt on U.S. creditworthiness or the dollar?
You want to get us started?
Yeah, I think that's a valid concern. It's not like this act alone is the thing that is, causing problems. Before this bill was passed, we were projecting 5 to 6% deficits into the future. This adds a point on top of that, so it just makes the problem even more worse. Moody's downgraded the U.S. In recent months, similar to other rating agencies. So it is something that's becoming more of an issue. John mentioned Ray Dalio. He, I think, somewhat recently said, the U.S. to get the debt picture under control needs to move deficits down from 5 to 6% up to 7, down to something more like 3%. And if we didn't do that, there's going to be some pain points, perhaps as early over the next 3 to 4 years. So it is something that we as a country need to address, whether or not that comes with a combination of higher taxes and reduced spending, or we just accept higher inflation and we debase the currency and inflate our way out of the problem. But it's something that we're going to have to address perhaps in the next 3 to 5 years.
Yeah, I'd add, we showed the unemployment chart with unemployment currently running at 4.1% and the troughs at other sort of strong periods in the economic cycles historically. If you were to plot deficits against that, what you should see, and what you did see up until about 10 years ago, is that deficit spending increased as unemployment was increasing. So in other words, the Fed was stimulating in order to help spur, growth, the second prong of its mandate. Employment growth is what I meant to say, which also leads to economic growth. But over the past 10 years or so, that there's been a departure. So we've been spending, even though from an employment standpoint, it doesn't seem like we need to spend. So we're racking up deficits that seem unnecessary relative to the economic health of the country. So to Mark's point, we're concerned. And as more debt enters the balance sheets or the balance sheet of the government, there's more concern. A bit of an offset to that is, and we shared this in our last webinar, households and businesses actually seem pretty well capitalized in terms of leverage. From a debt to household net worth standpoint, we're running along the lowest levels. Again, Mark talked about pockets of concern for some cohorts of Americans. And when it comes to businesses, the same is true. So essentially, after the global financial crisis, we moved a lot of debt from individuals and businesses to the central government, and now we've exacerbated that. We need to reverse course. Again, you can earn more as a country or as a business or an individual. You can spend less, or you can reduce your borrowing costs. We can talk more about that if that's a topic.
The potential impact of tariffs continues to be top of mind in our questions. What recommendations are you making to portfolios to mitigate some of the downside risk from new or ongoing tariff regimes?
You want to go?
You get started.
Yeah, look, I mean, we've clearly prioritized, like other countries have prioritized self-sufficiency. And so as tariffs go up, you're basically taxing, again, transactions. In the press, sometimes you'll see, oh, it's a tax on Americans. To some degree, maybe. Depends on the business and the product or the good or the service that's coming into the country. But it's also a tax on the exporters from other countries with their products and goods and services. So again, the share of that really is what you want to try to look at, who's paying that toll. But as those taxes go up for global trade and that slows, then by definition, you're protecting to some degree American businesses. You could argue about over time that might erode away the standard of living, which we've worked for decades towards improving in this country. But you would see, I think, businesses that maybe have been forgotten a bit in the United States, manufacturing, Midwestern businesses, companies that can move from manufacturing goods and products historically to other goods and products with AI and inventions or the advent of AI. So we like small cap stocks. They have struggled mightily over the past 6 months or so, but we have an overweight to small cap stocks. We've been looking at mid cap stocks as well in client portfolios. We haven't yet made an explicit allocation there, but we may in the future, just something that we're researching. But yeah, the tariffs by themselves might benefit some businesses in the United States while hurting others. And
just remember, markets in the US are all-time highs. So John showed the chart early in the presentation. We went from a regime where effective tariffs were around 2% to something north of 15%. And the market is not terribly worried about that. For the US, most of our economy is in services. So while there might be some friction points in the production of goods, for the vast majority of the economy, inflation or tariffs aren't really an issue. And if you think about the pockets of innovation and where the market's been led, it's in technology, and it's hard to see tariffs, really damping the impact of that, especially at a time where there's a paradigm shift with AI. So there's some things you can do on the margin. Maybe we're going to have slightly higher inflation as those kind of bleed through the system over the next couple of years, higher rates that has some implications for certain sectors and whatnot. But I don't think it's a shift across the economy where everything is going to be hit uniformly.
Thanks, Mark. Given the growing impact of AI, how are our portfolios positioned to capture opportunities in the space?
So we do own exposure to some of the big AI spenders. So the biggest, and we've touched on this in previous webinars, are Alphabet, Amazon, Microsoft, and Meta. Just those 4 companies, it's hard to believe, today represent about 25% of the S&P 500's collective CapEx spend. And you've seen Mark Zuckerberg in the press hiring executives from AI companies away at $1.5 billion. That kind of investment for small teams of people that are, rapidly developing AI capabilities. So we own those companies as well as other spenders on AI, including Google, which just Alphabet or Google that just released earnings yesterday. What's interesting, they beat on earnings, beat on revenue, beat on earnings, but you probably or may have seen that their AI spending is going crazy. In round numbers, it was something like coming into the year expected to be 55 billion. By the time we got to the second quarter, 65 or 75 billion. As of yesterday, they're guiding towards 85 billion in AI spending. So that's the consumption of AI. They call it an existential threat for their businesses around cloud services, computing, search, and so on. Search means advertising as well, or equates directly to advertising. So we do own those businesses. And look, there'll be plenty of beneficiaries. It's almost inconceivable to think that every business won't benefit to one degree or another from AI, just like every business has benefited from the internet. Some initially in the late 90s, 95, 96, 97, 98, 99. But today, virtually every business needs the internet in order to increase their productivity, to increase their warehouse management, to track and maintain shipping better and delivery services and so on and so forth. So we suspect that the impacts of AI will be durable. They'll affect all businesses and therefore all equities, maybe also offsetting some of the headwinds that we're facing from a population standpoint when it comes to birth rates, workforce participation rates, immigration, and so on. If you get productivity from technology, that's just as good as getting it from people or human beings. I started to laugh. So Musk, you may have seen Elon Musk recently came out and said that we'll have 1 billion humanoids rolling around the planet in the next decade or so. I don't know if we'll have that many. We're not making that call. He can make that call. But you can imagine the productivity gains that you would get if you could stay at home watching your favorite Netflix series and let your humanoid robot do your job for you.
I just add, the AI theme in public markets is heavily concentrated in components of the Mag 7, and just given the significant spends required. One derivative play of that is around utilities, because those hyperscale data centers require just massive amounts of energy and power. So we've seen some people do that to capture some of the AI investment. And then there's some things that we're doing in some of our private market strategies that are trying to identify private companies that play into AI as well.
Yeah, and we mentioned in the deck, or there was a bullet or two in the deck on AI-enabled defense. So to furthering Marc's point, that could be an area of investment. So something that we've been looking at and researching and becoming pretty interesting in terms of how do you help protect our country and our country's interests. So something that we've been looking at.
One of the questions here is with the Genius Act signed into law, maybe if you could give a little bit of background and kind of your long-term views on incorporating digital assets into client portfolios.
Yeah, I think the movement to crypto shares a lot of the same themes as investors moving into gold, just having something that's not centered around the dollar, just given some of the issues that we've talked about. Gold has been used in that capacity by more institutional investors, just given its timeless use as a store of value. But I think for younger investors, and especially with an administration that's very supportive of crypto, others are using it for that same diversification. The challenge with crypto is you just got to be willing to absorb a ton more volatility. I mean, you'd be comfortable losing a third of half of your investment in crypto, but it could rebound to something that's above that or multiples of that. So you have two choices: one that's more proven over long stretches of time with much less volatility, or something that is much more subject to major swings. So it's just, what do people want to bear from a volatility standpoint?
It's cryptocurrencies, like, we've had a less than favorable view on cryptocurrencies just as a broad sort of area to invest in. Obviously, they've gone up. We're not sure if that's actually driven by sensible investors that know what the value of any cryptocurrency is, or if it's just purely speculation and, for nefarious reasons. In our day-to-day lives, how many of us really see cryptocurrency being spent, on day-to-day transactions? You're seeing a little bit of that now, but it's pretty limited. But the whole notion is, what happens when you no longer believe in your paper currency or the value of the US dollar or the Japanese yen or whatever it is? You can no longer exchange those for what you thought that you could in the past. And gold, as Marc mentioned, has been a form of currency for 3,000 years. It is something that during times of turbulence, it has been a store of value, and has offered diversification at the right times when a client needed it. The challenge with owning gold is there are periods of time that you could go with it not performing at all. During the global financial crisis, it did swimmingly well. Then for the next several years, it was a drag on portfolios. And as Marc mentioned, in the past 3 years, up about 22% annualized, really contributing to portfolios and offsetting the market turbulence and the erosion of purchasing power. Cryptocurrencies offer some of the similar properties, but if there were one cryptocurrency, if there were just Bitcoin, we'd have significantly more confidence that that could act as a store of value. The challenge is there are new cryptocurrencies coming online virtually every day, thousands of them in existence. If you'd like, you can go out and buy the Melania coin or whatever your Dogecoin, which isn't even a bona fide coin, but yet it still goes up and down as if people are speculating. So there's just some concerns there. We'd rather go with gold and have more certainty and maybe some less upside, but the confidence that we get from gold as a store of value is significantly greater than from cryptocurrencies.
Thanks, John. Earlier, you shared your analysis of small and mid-sized American stocks going forward. Does that also apply to foreign small and mid-sized companies?
So we have had, and clients have asked us about our positioning for non-US based equities, both large cap European and small cap European equities. They've struggled relative to US stocks. And in particular, if you cut off just the growth stocks in the US, that's been the one place, the one area of financial markets that's done incredibly well over the past 12 or 14 years. But more recently, European stocks are doing well. As Marc sort of showed a chart, both the US dollar versus a trade-weighted index of other currencies, plus the US equities relative to European equities. But if you look inside of that, international small cap stocks, so primarily European, but Japan small stocks as well, have been really left behind. And so we've had an exposure there. We've been thinking about increasing it. So yes, both large cap and small cap, with a preference toward small cap international stocks, and value in both of those, value on the large cap side and value on the small cap side.
John, you showed a chart earlier that indicated that the market wasn't expecting interest rates to be as low as they were during Trump's first term. And what are your thoughts on how the market would respond if rate cuts are delayed until next year?
Yeah, I mean, look, the Fed has a very tough job right now. I mean, not only is Powell getting beat up every day, and I think Trump's tour of the Federal Reserve Building is
coming. Yeah, coming. That'll be fun.
Yeah, today or tomorrow. So there's $2.5 billion of cost overruns for the U.S. Federal Reserve Building in Washington, which I was just at last year, just doing a tourist thing. But it's an interesting thing. Like, the Fed's got a tough job. We showed some indications that maybe employment picture is starting to turn. Inflation has come down dramatically. But as Marc and I talked, it's still well above the Fed's target of 2%. The impacts of the tariffs haven't totally rolled through. Whether inflationary or deflationary, we're not sure. There are plenty of people that have a reasonable debate about that. It could just slow growth in any event and therefore not have an impact on inflation, but slower growth isn't good either. So if the Fed doesn't reduce the 1 or 2 quarter points this year or the 2 next year, you would likely see some headwinds to both equities and bonds. And if that's a response to inflation that has ticked up because of tariffs, then you could see maybe more material pullbacks in both markets. At the moment, though, we look at bonds and in particular municipal bonds that have struggled this year, and their yields are terrific at the moment. And on a tax equivalent basis, you're at plus 4%, non-tax equivalent. On a taxable bond equivalent yield, you're at 8 or 9%. Really potentially attractive place to be. especially if growth slows and inflation does not kick up. So I just wanted to link those two together because we've had some questions about bonds and our bond positioning as well.
The other scenario is if growth outperforms and you get GDP growth 2.5%, maybe even up to 3%. In that scenario, I think the market would kind of shrug off the lack of rate cuts because they're being paid for additional growth in earnings. So it depends on why. They're not going to make the cuts, but you also have you need the second part of that question of why aren't they cutting? So if it's because of growth, I don't think it's an issue. If it's because of inflation, that probably has some headwinds to the equity markets.
Yeah, and just one comment on growth before we go to another question. Look, in general, we're looking at the One Big Beautiful Bill Act as having about a 50 basis points temporary increase to GDP or economic growth in the United States, but that's largely offset by about 50 basis points decrease in the near term from the tariffs, combined tariffs package as they currently are situated. They're going to change. So basically a net zero impact from both the stimulative effect of the OBBBA and the restrictive impact of the tariffs, and then settling out at sort of what otherwise would have been growth at 1.5% to 2% real in 2026 and beyond.
Well, I think we have time for one more last question. As second quarter earnings reports begin rolling in, which companies or sectors do you expect to outperform or underperform? And what insights might these results offer about current consumer and business trends?
Yeah, well, we've seen banks, especially among the money center banks, report strong earnings, really capitalizing on the volatility in the second quarter. So JP Morgan, Goldman Sachs, that was a good quarter. I don't know that I would read a ton into that. It sounds like in some of their consumer businesses, they're holding up. I think you'll see strong defense, which is just a sign of the times, more conflict, more demand, which, as I said, in the One Big Beautiful Bill Act, there's additional funds there for more defense spending. Technologies doing well just because of the shift to AI. I think where you'll see some struggle, consumer-oriented businesses, you saw the results from Chipotle, just food service. I mean, it's hard for the lower income household to just make ends meet. Despite employment being low, they're still struggling with the effects of inflation over the last 3 years. We didn't talk about buy now, pay later programs. Those have skyrocketed, almost up 10x in the last 5 years. That data is going to be rolled into credit scores, I think, by the end of the year. So that might put additional stress on some of the data we showed around delinquencies. So definitely a mixed picture. Some things doing well, some things not doing well. But I think within consumer, there's definitely more challenges there than in defense and technology.
Yeah, I know we probably are coming up at time, but just given the questions that we just feel that I was just thinking about the tone here, there's a lot of concerns that people have, and so we want to respond to those. But there are also a lot of opportunities that we're seeing in portfolios. We position client portfolios to take advantage of opportunities on non-US equities, as we were talking about large and small cap value, diversifiers, including gold and so on. So we encourage clients to reach out to your client service teams to explore more about what's in your portfolios and why we do have a lot of confidence that portfolios will do well going forward.
All right, thank you, John, Mark, and Jan. It looks like we've covered most of the questions we received today. We truly appreciate your participation, and thank you for sharing your thoughtful questions. If we didn't get to your question, please rest assured the Aspiriant team will be reaching out to you in the coming days. In conclusion, while we remain optimistic about the opportunities ahead, we understand that the policy uncertainty and market turbulence can feel unsettling. We hope that today's discussion has given you confidence in the research we conduct and the insights we gain as we manage your portfolios in a disciplined and balanced manner. We deeply appreciate your trust and partnership as we continue to navigate a continuously evolving global, economic, and political landscape. As always, your client service team is here to discuss any thoughts you have about the markets or your portfolio. Please don't hesitate to reach out at any time. Thank you again for your time and attention today. We look forward to having you join us for our upcoming webinars. Be well and enjoy the rest of your day.